value line criteria. And what this is basically saying is basically looking at several fundamental factors and how they can be used to select a stock. So basically, I'm just going to be listing them out. I'm going to be spelling them and how its impacts or and describing its impact on the stocks or on your selection of stocks, basically. So now let's now look at the first one of this value line criteria. So the value line criteria, the first aspect of it is saying that when you have certain stocks, or we are looking at progressive growth of a stocks, or we are looking at the progressive growth of a stock, right? You have to understand that within 3 to 5 years, or in the range of 5 years, right? If the yearly highs of the stock is not 2 times of the yearly lows in 2 years out of those 5 years, then that stock should not be picked. Now, I'm going to begin to sound technical, but then I'll try to break it down as much as possible to get. So, what do I mean by yearly highs or yearly lows? Now, if you look at a particular year, a particular trading year, the yearly high is basically the highest point in which a stock traded throughout the year. So let's say a stock was moving between $430 to $480 throughout the whole year. Like it was just going within that range, 430 for the get. So the yearly high, let's say it now stopped at 476. Like that's the highest point it ever got to. That's the yearly high. You get the yearly low, of course, will now be something lower, like the lowest point in which it got to in that particular year. So that's basically the yearly low. So in 2 out of those 5 years, right, the yearly high must be 2 times the yearly low. And this first criteria alone, or this first part of this value line criteria, can eliminate a lot of stocks for you already, because a lot of stocks find it hard to, like say, hit um this particular metrics from my point of view, because I've reviewed a lot of stocks, and this one alone basically clears out like a large percentage. Even if you are doing your own analysis right now and you begin to use this value line criteria, once you begin to implement this first part, you begin to see what I'm talking about. And like I said, you can always find this data using your stock screener. You get, just go to information, check for the yearly highs of a particular stock and check for the yearly lows of that particular stock. And if in 2 out of 5 years you don't see this metric aligning to that stock, then you should kick it out. The second aspect of this is that if the stock price is too expensive, kick it out. And I'll give you a practical reason why you should do this, right? A stock that is expensive, the tendency or the prospect for growth is lesser than a stock that is cheap. And although this might sound unrealistic, or let's say like an ideal, it is actually what is on ground. Because if you look at those expensive stocks, those that have 400 and those are what 438, those are what's like very very expensive, see that their prospect for growth is very very reduced, right? Especially in let's even look at the aspects of capital expansion and the likes. It's super reduced. Yeah, so the prospect for growth is super reduced, and that's why it's better to go for stocks that are way cheaper, right? And I'm not going to give a particular let's say, what's the word, I'm not going to give a particular great range towards what you can classify as a cheap stock, but you can basically define it by your own knowledge, from your own analysis, what you are seeing, basically what you are seeing from the market. You can basically define what you consider as a cheap stock for you. But for me, I consider a cheap stock to be going within the range of 10 to 50 USD. That's the definition of cheap stock. Anything you see going between 10 USD to 50 USD is more than cheap. Then also the third aspect of this is the PE ratio. So what we are calling the P ratio is basically the price of a share, or the price of a stock divided by the earnings per share. This is known as the P ratio, and the P ratio is a very good indicator of the health of the company. And the P ratio is not to be used in It's not to be used in an individual sense, it's meant to be used in a comparative sense. And I'll give you a perfect reason why. If you look at the PE ratio, um, because there are certain firms in a particular industry, so the PE ratio is best used when you are comparing it to other firms in that industry. A great disadvantage you will be in, or you put yourself in, is when you begin to use the P ratio of let's say a company in the manufacturing field to the P ratio of a company in the telecommunication field. Like the industry is wide to get, like, is miles apart. So using that P ratio, you're not going to compare that, because okay, let's say the P ratio of this firm in the manufacturing industry is, let's say, 30%, and this one here is now, let's say, 25%. And just to put this in perspective, the lower the P ratio, the better, right? So because of that, you now say, okay, because this one is 25, this one is now a good stock. But you now look at the other industries, the other company in this particular manufacturing industry, and they have P ratios of, let's say, 60 something, 50 something, and this one is good for 35. I look at the other ones in this telecommunication industry, and they have like, some are going for 35, some are going for 40, some are going for 20, and then you realize that this is not actually the best. And then you just, because of you used cross industry, you get to make a lot of mistakes. So you have to use your P ratio in a comparative sense. And like I said earlier, the lower the P ratio, the better. So this on its own also helps you to kick out some stocks, because you look at some stocks in a particular industry, you now ascertain, okay, this is the best. You can pick like as much as 3 stocks, 3 to 5 stocks per industry, and just kick out the rest, because you are looking at excellent P ratios. So with these three, you should have done like a huge damage to, let's say, I won't call it a huge damage, I'll just say you would have done a huge plus to your selection of stocks. Basically, you'd have eliminated a lot of unwanted stocks, and you'll be left with basically the good ones for investing. And the final one we're looking at is the high 5 year appreciation rate. Now, if you look at your stock screeners, you basically see year to date, you see 1 year, you see 3 years, you see 5 years. If you look at the 5 years, and then you are seeing a very good appreciation rate, let's say it should be going for 75 to 100% ish for 5 years. I feel that's excellent. I look at this, and then you are seeing this is a good sign. A 3 digit is a big plus. Not It's rare to see a 3 digit 5 year appreciation rate, but then it's a good plus. If you see it's a good plus. So you have like thousands of stocks to examine, so it's your choice. I'm not going to tell you the stock to pick, right? You use your own hands, you use your own analysis. From what I'm telling you, you basically define, okay, this is a good stock and this is a bad stock, and then you go on with it. So I'll give you four, and this is basically the components of the value line criteria. The first one talked about the yearly highs and the yearly lows. Second one talked about the price of the stocks. Too expensive, too cheap. If it's too expensive, kick it out. The third one, we looked at an excellent P ratio, and I said to determine this, the lower the P ratio, the better the stock. And also, it's not to be used in an individual sense, it's meant to be used in a comparative sense. Then the fourth one, we looked at the high 5 year appreciation rate. So with this, we end the value line criteria. Now the second one we're going to be looking at is the book value. So I'm going to be looking at the based on book value criteria. And this is another, like I said, you can use, you can, let's say, now I've given the value line criteria and there's a book value, right? You can say, okay, I want to combine value line and book value. You can say, okay, I'm going to stick with value line. You can say, okay, I'm going to stick with book value. You can say, okay, I'm going to pick, let's say I want to pick the first three of value line. Okay, I'll pick this one, so of book value. It depends on how you want to use it. You can use it in any way you want to use, but this will point you to the direction of those good stocks and bad stocks. Yeah, and then this book value part is going to be, will I say, um those that have an accounting sense or an accounting background are going to understand this part more than those that don't have any accounting or financial background. But that's not to bother you, right? Because I'm still going to break it down to a point where you can definitely understand it and you can do your own analysis by yourself. So, what do we mean by book value? So, in the stock sense, the book value is basically your assets minus liabilities. Then, your book value per share will now be your assets minus liabilities, which is your net worth, divided by your common share outstanding. Shares outstanding. So let's now use a perfect example. If let's say the assets of a company million and the liabilities of the company was 250 million. So if we now want to determine the net worth of a company, you're going to do your assets minus your liabilities, which will give us 250 million as your net worth. So this is basically your book value. But then your book value per share will be, okay, let's say 250 million, and then the company has 1 billion shares. 250 million, company has 1 billion shares, so which means the book value per share is going to be 0.25. Right, so this is how you calculate your book value. Now that was basically just to emphasize what the book value is. Let's now look at the components of this book value criteria. So the checklist for this is: number one, the price of stocks. Same thing that is applicable in the value line criteria. If the price of the stocks is too expensive, kick it out. And from analysis in the last 1 year, I've basically been doing a lot of kicking out of expensive stocks because I find out that those who, like I said earlier, the cheaper ones have a greater possibility of growth or a greater potential for growth, while those that are so expensive, they don't really have a great prospect for growth, right? The second one I'll talk about is the price to book value. So you have to stick with me. So what do I mean by price to book value? The price to the book value is basically the share price divided by the book value. Are you getting it complicated now? No. You should get it complicated. Let's go right again. Right now, like I said, the book value per share is going to be what your book value divided by what common shares outstanding, right? So your price to book value is basically going to be the share price. Share price could be any number basically divided by the book value per share. And when you do a calculation, because I can't give a particular answer to what it might be, is dependent on the companies that you're analyzing and all. Once you get this price to book value, the checklist for this is saying that, because I did my analysis over some certain stocks and I read some books too and basically confirm my own what I call it assumptions, and I found out that those that are within the category of 1.0 to 1.0 are those that have the greater prospects for growth, that like the good stocks. Anything above 1.0, mm, you should flee. You should begin to run away from those stocks. Anything above 1.0, begin to run away from J stocks. And you can basically do your own calculation as I'm talking. Once you watch this video, you're going to do your own calculations to get. If you have any questions to get, you can also reach out. You can always reach out to exec.assistant.ceo crispino@gmail.com for any complaints, questions, and the likes. And if you have me on Telegram, you can reach out to me. If you have me on Instagram, you can also reach out to me, because I'm sure a lot of you will be asking questions. You can also leave them in the YouTube comment section, and I'll be sure to answer. Right now, let's now look at the small cap stocks, which is the third criteria under this. So what basically this is saying is that you have to classify stocks based on the market cap. And like I said in the first aspect of this stock investment masterclass, we have three market capitalization, three ranges of market capitalization. Basically, the small cap stocks, we have the mid cap stocks, we have the large cap stocks, and various exchanges have their own definition of what small cap, mid cap, and large cap should be. So you have to understand the one for a particular exchange, right? In some exchanges, basically, small cap is anything lower than 1 billion, anything lower than 1 billion USD. Mid cap is anything between 1 to 5 billion USD, and the large cap is anything above 5 billion USD is a large cap stock, right? And under the book value, what you're basically looking at are, you are focusing on the small cap stocks, like I said, because these ones have the growth for the potential for growth. these ones have the potential for growth. So you have to look at the small cap stocks. Very, very important. And you see, you always hear me, I think I mentioned it like 3 or 4 times now, potential for growth, because this is basically how you make a lot from the stock market. See, those that invest in stocks, okay, you might want to invest in your growth stocks and like see that those ones are basically sticking around 10, 12% a year. But when you look at likes of value investing, you can go as high as 20, 30%. Right? So and I know this is what people want to get. Nobody wants to find themselves below the inflation rate of the economy. Poor. Right? So this is why you have to look for those stocks that can give you a great growth potential. And the small cap stocks are stocks that can offer that. Finally, we're going to look at in terms of the progressive growth. One thing to consider when you're looking at the progressive growth of a stock is basically its price to book value ratio. That's what I talked about earlier, and then in combination with the return on equity. Right, and to do this well enough, you have to understand that we can either have a falling price to book ratio or a rising price to book ratio. Progressively, we look at the progressive aspect of it. Even though let's say it was 2 point something the first year, or let's say it was 1 point something, 1.5, the price to book value, let's say it was 1.5, then it went to 1.7, then it came down to 1.3, then it came down to 1.2, then it came down to 1.0. Now this is a falling price to book value ratio. Although there was a pump before from 1.6 to 1.7, it doesn't now ignore the fact that it was sloping down. Okay, so we're looking at the progressive, you get, and we now look at the return on equity, you get. We can also have a rising or falling. So when we consider both aspects, because we're looking at it one like simultaneously, this fourth aspect looks at these two simultaneously. The first aspect I talked about only looked at the price to book value ratio, and then I told you anything between 0 and 1.0 is a good stock, right? So now this aspect looks at the two of them simultaneously. It's okay, and the